How did you experience it?
I guess I had a different experience. I actually think it's funny to think of like VCs as like the FEMA showing up after the hurricane type of thing. That's like kind of
making
like
podcasts and tweet threads about it.
I did put on my little red cross and
Not a dividend.
It's a tale of two Kwan.
Now your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Unnamed trading firms who are very involved.
I like that ETH is the ultimate Ponzi.
DeFi protocols are the antidote to this problem.
Hello, everybody. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intros. First, we got Tom, the DeFi maven and master of memes.
Hello, everyone.
Next, we got Robert, the crypto connoisseur and czar of Superstate.
Good morning.
Next, we've got Tarun, the Giga Brain and Grand Poobah at Gauntlet.
yo.
Joining us today, we've got special guest Doug Colkitt, liquidity luminary at Ambient Finance and Fogo.
Hello.
And I'm Haseeb, the head hype man at Dragonfly. We are early stage investors in crypto, but I want to caveat that nothing we say here is investment advice, legal advice, or even life advice. Please see choppingblocks.xyz for more disclosures. So we were actually planning to take this week off, but unfortunately, we were brought back on the job on overtime because we have just experienced the most wild weekend potentially in crypto history, the single largest day of liquidations ever. It was an absolutely chaotic weekend, and it all really happened on Friday. So Friday, for those of you who are somehow not paying attention to what's going on in the world,
I wasn't paying attention.
Trump issued massive threats against China for withholding rare earths from the US and basically said, we're coming back at you, new round of tariffs, and this time they're bigger, they're badder than ever. He elicited this threat late on a Friday evening, US time. And this caused markets to immediately crash, and crypto markets crashed much more severely than almost anything else because, of course, crypto could continue trading even as markets closed on Friday evening. So we saw the single largest day in liquidations ever, over $20 billion liquidated. Over 1.6 million crypto traders were liquidated over that time, mostly longs, liquidated much more so than shorts. Now, these losses you saw across the entire crypto market caps. So large caps fell about 27% on average. Smaller caps lost 52% on average during the course of the day. Peak to trough, we saw some tokens completely cratered to basically near zero. Atom, very notably, hit less than a cent on Binance over one crazy wick. Multiple assets went down over 80%, and that did later recover in the day, but insane levels of volatility that we have almost never seen, rivaling only the COVID crash and the FTX crash. Of course, crypto is much bigger now than it ever was during the COVID or FTX crises, making the dollar notional amount that were liquidated in this sell-off the biggest that we have ever seen unequivocally in history. We saw gas spikes, all-time high on Ethereum, more than 2 times previous high. There were people showing screenshots of them paying $400 gas, $1,000 gas to get transactions into mainnet. And according to some people, there were potentially even more liquidations that were reported because the single largest venue for liquidations was Hyperliquid. Hyperliquid showed over $10 billion liquidated on Hyperliquid alone. But of course, Hyperliquid is nowhere near the largest venue, implying that probably many of these other venues are underreporting their liquidations. And so probably the real number is much, much larger than what we saw. At the same time, we also saw most of the centralized exchanges have major downtime. So Binance famously was down for like roughly an hour, not fully down, but had massive instability in their APIs. People were not able to get inventory in and out of Binance. It's a large part of the reason why so much of the assets that massively drew down were only on Binance. As huge spreads that we saw between exchanges, market makers just completely unable to quote. Over 25 minute blackout, huge API throttles, and Binance ended up refunding over $250 million of people who were incorrectly liquidated over the period of that day. They came out and said, mea culpa, we messed up, we're going to make it right and try to refund some of the people who lost money. But overall, it was a massive day of wallet instability, multiple APIs, RPCs that were failing. It was a crazy, crazy, crazy day. I'll stop there. People get the overall picture. Love to get color from you guys. How did you experience Friday and the ensuing aftermath going into the rest of the weekend?
I'll go first because I feel like this is the easiest answer and it's a bit of a cop-out. And I'm going to be like furniture in this episode. I wasn't really trading. I didn't have any positions on. I saw a bunch of Telegram groups I was in blowing up and people were freaking out. And I was like, yeah, I'll take a look at this tomorrow. So I missed the whole thing. I didn't sweat it. I'm not a
And to
trader.
be clear, if you were holding spot Bitcoin, you don't even notice anything happen because I think Bitcoin went from like 120 to like 108, I think, and then ended at 115.
Yeah,
So,
like I
Bitcoin
was like,
mostly fine.
I pulled up CoinGecko. I saw a lot of red stuff. I was like,
Go
like,
back to
I'm not
sleep.
using any leverage. I'm not trading any perps. Like, I'll see what all the commotion's about later. So I missed the whole thing.
Good move. Good move. Tom, what was your experience?
Yeah, I mean, in some ways, also as a VC, you're also somewhat of like a non-combatant. It's like you were pitting portfolio companies and making sure they're okay and kind of assessing the damage. But like, I also don't have a big position on one of these perp exchanges, so I'm like not as much sweating it personally. I do also maybe have some sense of calm. I guess similar to you guys, like been in the industry been through I think pretty much all these other big wipes and. I think for all of those, there was always kind of you don't know where it stops, right? Like during COVID or during FTX, like you don't know what the next one's going to be. This felt like very, idiosyncratic and like, okay, there's this weird, Trump tariff scheme, but like there wasn't anything more, I guess, fundamental to the market that would make you kind of freak out.
Tarun, how did you experience it?
I guess I had a different experience. I actually think it's funny to think of like VCs as like the FEMA showing up after the hurricane type of thing. That's like kind of
making
like
podcasts and tweet threads about it.
I did put on my little red cross and start tweeting.
Yeah. So I had a kind of different experience because Gauntlet, we run something like $400 or $500 million of delta neutral strategies. So I had direct experience with getting auto deleveraged in different places and dealing with downtime. And I will say, I think the war between Binance and Hyperliquid over who is more transparent seems to be a Pyrrhic victory for whoever wins that, because the ADL policies are not at all transparent, and we'll talk about that later. But I actually think this kind of entire episode showed a lot of secret things that are like purposely kind of opaque in both centralized exchanges and decentralized exchanges. And those things that were opaque were the things that caused the most like trader harm. And of course, I think the most hilarious thing about this in hindsight is like, as always, this taco trade thing of like Trump always chickening out happened like almost in like 12 hours. It was like unreal how fast it happened. But I do think like no one kind of comes out looking very well, looking good. And I can talk through how I think like everyone kind of has egg on their face from this.
Yeah.
But
well, so actually,
we're lucky that
mentioned
the taco thing V-shaped.
Yes. Although not a complete V for a lot of alts.
Not a complete V, but like enough that, to Tom's point,
yeah.
During the FTX, every day you were like waking up with some heart palpitations of like, is it finally fucking over? Whereas like this was like not that.
That's true. It was a pretty quick, okay, it happened and then, okay, it's over and we can tell that it's over. So Doug,
if you didn't see the chart, you wouldn't even know probably. You just saw the number, right? Like,
right.
Yeah, I looked at it a few days later. I'm like, wait, something happened. Besides, now I've learned the phrase ADL.
This was like the
everybody now knows
flash crash. You remember the
everybody now knows
it's a lot. Yeah, it's a lot like 2011 flash crash.
It feels like that more than a real.
Right. So everybody now has learned the term ADL, and they've learned it probably mostly through you, Doug. So do you want to explain for our audience what is ADL, especially for those people who don't trade perps, don't really know what any of this stuff is talking about? Explain auto deleveraging and what role it played over this weekend.
Yeah, for sure. So, like I think the most important thing to remember about perps are they're imaginary, right? So you go long or short on BTC. Perp, there is actually no BTC in that system. So your ability to be short is only predicated on the fact that there's someone else willing to be long. They have cash in the system. So if the system, normally that works fine. People get liquidated. Someone else comes in, buys lower. Margin calls, people step in, the market works fine. When it doesn't, when there's not someone willing to step in or willing to step in at like a reasonable price, right? Like eventually you have to start taking people out of the system. There's no one, if there's no one willing to be long, right? Like you have to start closing out shorts or vice versa. So, I mean, the simplest way to think about it is just like ADL is what happens when a perp exchange runs out of counterparties.
So how did ADL actually play out? Like, so
how did it play
you were
out?
saying
So,
that,
So what happens, what happened on Friday is that, right, like obviously BTC dumped. I think you had a lot of leverage in the system, maybe because people were like farming points and they were doing a lot of these delta neutral strategies, long on one, short on another. But right, what happened is you started getting this cascade of liquidations, especially on Hyperliquid and Binance too. I think Binance had a bunch of ADL as well. And you start taking eventually, right? There's nothing left in the order book, and the way the system's set up is it will not fill a liquidate at Hyperliquid, at least it will not fill a liquidation at a price where it would make the position have negative equity. So if you only have X amount of margin in your system and your bankruptcy price is, let's say 105, and the price in the market is like 103, it picks someone on the other side and it says, well, number one, you're going to be a forced counterparty, and number two, you're going to be on the other side of this at kind of a distorted price. So ADL does really two things. Like one, it takes people out of the system, and two, it has like this socialized loss function that keeps the exchange from being insolvent. So what happened is you started hitting a lot of ADL around like 108, 107, 106, like, and so that started taking a lot of longs out. And people are doing this delta neutral stuff. So they, would be short BTC at, Hyperliquid, long BTC at lighter, and kind of getting points on both sides, or maybe they were short BTC and long ETH on Hyperliquid. But you take the short side out, and now you have a bunch of people who are naked long, and they get liquidated. They get ADL'd at 108 on their short, and they get liquidated at 102. Well, that's like a major loss. So you think you have a hedge position and you're safe, but you're not, right? Like you come unhedged and at bad prices.
So this is one of the reasons why, perps, when everything is working well, perps are a beautiful product. People are like, oh, perps are so great. Why doesn't traditional finance use perps like all of us crypto degens? And it's like in times of real instability that people realize like, oh, perps are really not like dated futures, in that there are these edge cases where, like if you just have a future, you just hold it to maturity, you really can go to sleep and wake up at expiry and say like, okay, things are, my position will still be there. Whereas with a perp, like this is what happens when the system goes through real crazy imbalance, where everybody wants to be short and nobody wants to be long. And it's like, okay, well, there's nobody to pay you. There's nobody on the other side of this trade. So sorry, the trade is canceled.
There's no more
right?
trade.
You're no longer short this thing because there's nobody to match you.
You've made too much money. You've won too hard.
You've won so much. We are sending you home.
It's actually what they do when they're picking positions to ADL. They rank them, and the two criteria they use are how much P&L you're up and how much leverage you're using, right? Because number one, like the people who made the most, you figure, okay, you're going to be the least unhappy if they take you out, and you leverage, right? We want to take leverage out of the system, because if it shoots back up, you get liquidated on the other way. So you're trying to take leverage down. You're trying to take most profitable people. Where that breaks down though is the delta neutral stuff, because you can have massive P&L on one leg, and then you have a big loss on your other leg, and you're not actually profitable, but like from the ADL system's perspective, they think you're a big winner. Like, why are you going to complain?
Yeah. So this was, I think, part of what was so rattling about Friday was how unpredictable people felt it was that, there were reports of people who were getting ADL'd multiple times in the same day for, okay, I was ADL'd on the way down, and then I got in and I was ADL'd on the way up. And like, it sort of led to a total breakdown of the predictability of perps as a way to express a market positioning. And if you were in spot, like, to Robert's point, like you were fine. You never noticed anything happened. Everybody who was in perps noticed that the market was just breaking down under all the load. And of course, a big part of why things were so lopsided was because of the fact that the APIs were not working. And when the APIs are failing and like people can't get money into Binance, the single largest venue in crypto, then like you just have these massive dislocations where, some people were posting like the SOL price, and it was like spreads of like $20 across different exchanges, because there were some places where it was trading at 200, some places it was trading at like 175. And that kind of dislocation, like that's like a 2015 kind of discrepancy that was just like, it just meant basically that there was a total breakdown in the ability for market makers to move inventory across exchanges. So one of the notable stories from the day was a massive Depeg that took place on Binance across 3 assets. The first was Athena's USDe, which is the stable, synthetic dollar that Athena has, and then 2 staking tokens that WB ETH and BN Sol, which are the sort of staked ETH and staked Sol equivalents that Binance has. And these 2 assets, so USDe traded down to 68 cents on Binance before finally recovering. Now, for other venues, and I wrote a big tweet thread about this, other venues actually did not have this problem. So if you look at Bybit traded to like 95 cents for USDe for like 5 minutes, and then quickly recovered the peg. And if you look on Curve, which is the most liquid venue for USDe, it was at basically $1 the entire time. But Binance had this huge leg down, which got pretty widely reported as, oh shit, USDe is depegging, blah blah blah, it's breaking. At the same time, these 2 other assets, the what is it, WB ETH and BN Sol, they went down like 80% before regaining their pegs. Now it was claimed by YQ, who's a founder, Asian founder, who was saying that he thinks actually what was happening was a coordinated attack, because USDe was used as collateral for WB ETH and BN Sol, and if you could push down the price of USDe on Binance at a time of instability, you could liquidate a bunch of people's WB ETH and BN Sol positions or something like this. Like there's something about like the index weighting where they were not using the redemption price, but they were using the order book price. I don't know if you guys follow the story, but there's a lot of theories floating around about what exactly caused this and whether this was actually an attack.
I have a more Occam's razor / less adversarial theory for why the USDe USDT order book was so skewed. One really big event in the last 2 weeks for USDe was the getting added in Binance collateral, but also being used for farming plasma. And in particular, there was Binance Earn, where users could just like click a button that said, hey, use the stable asset. I think actually it did say stablecoin in the doc, but obviously maybe not. It shouldn't be kind of described as that. And earn, up to 30% on plasma. And plasma was, at ICO was like quite high market cap wise, like 20+ billion. Now, plasma was one of the first assets to have this huge collapse, had a really violent collapse on Friday. And that was right around the time the USDe USDT order book kind of started unwound. And I think there's a more boring explanation than like there are all these people trying to snipe the index construction methodology. Is there were a lot of users who've never used Athena before, didn't really know they're using Athena. They clicked a button on Binance that said get 30%. And they see XPL going down and their 30% looks like 6%. And they're like, exit, exit, exit. I want USDT. And this kind of mass of users who they might not have even known they were using Athena, right? There was $2 billion that went into Binance Earn. And I'm sure a lot of those users didn't even know. They just like had Tether on Binance. And so I think there might be like more naive explanations like that of like some of these really low liquidity assets really had these like collapses that in the UXs and in a lot of centralized exchanges looked like people's yields went down 80% and then they exited and they hadn't, it was like the timing around that to me was like kind of very interesting.
You think that happened fast enough for like?
Yeah, you think like people are slamming like I'm not getting enough yield button?
No. I think there's people who copy like once the USD USDT book started lifting, there's tons of market makers who just copy trade it down, right? Like momentum wise, and that can become a self-fulfilling prophecy. So like that to me is, I don't know if it's like this like index weight manipulation. It seems like very complicated and you have to time it perfectly. Whereas like, just copy trading all these people exiting this earn product, it seems like
So I agree that it's an exotic theory. And I think like the base case is just that somebody was like, hey, I don't want USDe, I want USDT because market's dumping. That does seem more plausible, and that just no market makers are able to step in and provide the inventory to bring the peg back. That being said, I think it's not implausible that somebody just had an algorithm that was sitting there waiting, like, look, if this thing goes down a cent, just ram it as hard as you can down, and then start shorting, BN Sol and whatever else.
Or somebody was getting margin called on their perps.
Yeah, I think that's
speak, and they were like, I have a huge position. I need cash instantly. Like, who cares about slippage if I'm going to lose way more money? Again, I don't have any clarity inside of Binance because it is a centralized exchange that is somewhat opaque. But my hunch is just that like people needed money urgently, as they do in flash crash scenarios. Everyone's getting liquidated. Everyone's running around like a chicken with their head cut off. Someone just hit the sell button to get cold hard cash.
Or the liquidation engine just, I mean,
Yeah.
you could use it as collateral and just force you out.
Well,
if you're
I do
gonna-
think the USDe listing as collateral timing relative to this was like, it wasn't that long ago, right?
Right.
So
And
it's
there's
like,
so much interconnectedness that like
Yeah.
Well, the thing is, the part of the reason why YQ pointed out that this theory would make sense is because there was only a couple days until they were going to change the methodology for BN Sol and WB whatever ETH, and after that, this attack would not work. And the fact that they depegged so aggressively relative to everything else, like no other staking token crashed in the way that those two assets crashed, and those two assets were the only two assets that were going to have their.
I just think I think like, I believe it's an accelerant that like once there was starting to even be a small deviation, people started maybe looking at that. But I suspect it's like something really dumb that started, like the true, like, first domino was probably not that. That's like my strong belief.
That's very plausible. And to be clear, we'll probably never know because I don't think Binance would publicize it one way or another. One of the things that was interesting, people were talking a lot about the microstructure, and Guy was pointing out that, like, hey, a big part of the reason why Binance dislocated so much beyond just Binance's own instability and API issues was that Binance, unlike many of the other exchanges that integrate USDe, Binance, one, they were using their own order book as the oracle price, as like the index price, which is not what you should do if you're not the primary venue, which Binance was not for USDe. They were not looking at any of the other prices, which caused them to liquidate USDe way too aggressively during the flash crash. And that liquidation, to your point, is like further caused more selling and just drove the USDe price down. And then second is that all the other exchanges have integrated mint and redeem for USDe. And so if you're a market maker and you have inventory on Bybit, you can directly mint and redeem and do peg arbitrage for Athena. Binance was the only major venue where they didn't have that integrated. And so as a result, if you're a market maker, you can't get inventory in, you're not going to take assets off exchange and then go do peg arbitrage, right? Because it's just like, especially when the APIs aren't working.
Well, the API's
So,
off. Like nothing is
yeah,
working.
Yeah, exactly,
yeah.
exactly.
Exactly,
If the
yeah.
APIs are failing, like you're not going to click your way into like bringing your assets out. So it was just it was kind of a perfect storm of everything going wrong with respect to the market structure on Binance. And so this is also part of the reason why they specifically Binance only gave refunds, $250 million worth of refunds to people trading USDe, BN Sol, and WB ETH. Those three assets were the ones that got 250 million plus worth of refunds from Binance, who identified that, hey, these improper liquidations, we're going to make you whole. That to me seems like a sign that this was not just like, oh, somebody innocently got liquidated and it wasn't really an issue on their part. That feels to me like something must have been wrong that they identified, like, oh, we fucked up beyond just the oracle construction. Okay, so one of the other stories, of course, is who did well and who did poorly. And this is what a large part of what's been debated online is like, hey, DeFi, obviously, everyone's like, oh yeah, Aave was great. And, Morpho, they liquidated stuff with no bad debt, which of course is like, okay, it's easier for them to, get through this than it is for the perp dexes. Would love to hear your guys' reflections, especially maybe Doug, because I know this is something that you've spent a lot of time on. Tell us how you saw how DeFi, especially on the perp dex side, how it fared relative to what happened in CeFi.
Yeah, I mean, I think right, like it depends on the perp decks. Some of them had API issues too, and I think right, like this kind of opens up how decentralized are some of the perp dexes if they're just an API or a box that's sitting somewhere. As far as I know, I think Hyperliquid held up pretty well. I think it dragged a little slow. Lighter had a bit of offline time, but luckily that was after kind of the craziness, so people could still get stuff in. So I think in terms of performance, the perp dexes did pretty well. I think they were pretty comparable to centralized exchanges. Obviously, the transparency is a big issue with centralized exchanges. I think that kind of stands out there is that there's some stuff around like ADL or what the methodology is at Binance and some undisclosed stuff. And people aren't happy about that. And whatever you want to say, like about, ADL, at least like Hyperliquid's very transparent. Like these are the formulas, this is what we use, everything like that. In terms of the end users, one thing about perps are they're zero sum. So for every winner, there's a loser. And so I think like not an insignificant number of people made money. They're just maybe not yelling about it on Twitter because it's a bit tone deaf to do that.
Yeah, it's in very poor form to be celebrating when everyone else has lost bigly.
Yeah, exactly. So I think there are some people who are still fine. And then the people I think who really got screwed are the delta neutral farmers. I kind of said this before, but if you were, you thought a lot of people have gone into this strategy long on one perp deck, short on another, and you're collecting points. And I think that produced a lot of kind of artificial OI in the system that was probably a big contributor, like to the kind of the violence of the deleveraging.
So, okay, it's funny because I actually brought up this point in a panel I was doing today at DAS, which is the point you just made, which is that, look, perps are zero sum, right? And so, like, to the extent that this was a derivatives driven event, it's not like half the people won, half the people lost. Like mathematically, that has to be true. And yet that doesn't feel right at all. Right? It like doesn't seem like half the people won, half the people lost.
So
right? Because that should be true on any given day.
I think there is actually a question of like the types of agents who won and lost, and like this is just a fundamental thing about exchanges and their users. In these tail events, they are extremely adversarial to each other. Exchanges make decisions that either choose to preference the exchange right now, i.e. keep the exchange solvent right now and not lose any revenue like instantaneously at the expense of sort of traders whose positions get stopped out to cover very lost positions, right? That's like the socialization. And this is sort of not something unique to crypto, by the way. I think crypto people just think this is kind of like unique to perps, but like the whole Basel III framework is about interest rate swap clearing. And interest rate swap clearing has this exact same problem of like when there is a sort of liquidation event, how much do you get apportion the loss to the exchange, and how much do you apportion the loss to the set of traders involved? And in general, the different exchanges took very different perspectives on this. So in the case of Hyperliquid, HLP depositors were preferenced in a lot of ways over a lot of profitable traders, in the sense that they had very aggressive auto deleveraging. So and then basically HLP got to kind of make the profits from that. And in some sense, that is sort of this belief that you're zero sum kind of always, in the sense that it's either the exchange that loses and goes insolvent, or it's like the profitable traders who kind of lose because their positions are cut early. But I think there's this old saying from poker. I'm trying to remember this guy, Amarillo Slim. I remember kind of like a long time remembering, which is you can shear a sheep many times, but you can skin him only once. Referring to kind of like the difference between kind of like poker sharks and minnows. And there's a sense in which if you preference the exchange's preferences over your traders who are profitable, and those are likely the highest future revenue generating traders, they may not come back to your exchange, or may lower their size because they're like, exactly at these tail events when I'm making the most money because I predicted the directionality the most correctly, you stop me out. Like, why the fuck would I come back? And so I think this is going to be an interesting design choice that we're going to see. And fundamentally, I think a lot of these ADL mechanisms are very non-transparent, right? It's like, in the case of Binance, it's like your relative P&L times effective leverage is how you get ranked. In the case of Hyperliquid, it's just like your relative P&L. But these are sort of like greedy algorithms. They don't actually necessarily optimally match like losing positions with winning position, like the minimal number of winning positions to get solvent. They're actually just greedy algorithms that are like, pick the biggest thing, pick the biggest thing, pick the biggest thing. And in these cases where there are, to Doug's point, these kind of people who are doing these cross trades, oftentimes their positions get picked off the most, even though they're like not contributing the most delta or risk to the order book in the case of insolvency. And so these might sound like technical, nuanced things, but like literally half of the fucking Basel III is about this type of stuff. Like that's why it's like 5 million pages. That does sound very
technical and nuanced.
But I think all of the perps exchanges are kind of slotting themselves on a spectrum of like how much they value the exchange and how much they value their highest value traders. And they're making this decision between instantaneously, it's zero sum all the time, or I view the long-term thing of like trying to retain users, but maybe the exchange has to eat some amount of insolvencies, right? And that's
Well, but there's
that's
no
I don't
exchange
think
that was
any-
internalizing a loss.
Yeah, I don't think any lighter had less ADL, but I think that was partially because LLP was providing liquidity into.
But that's what I mean by the equity holders.
Yeah.
Yeah,
But that,
you're
that's
talking about
not
the
the
LP
equity
vaults,
holder of
not
the
the
exchange.
exchanges.
Yeah.
Yeah.
So
Sorry.
BitMEX-
In indexes, right? The LP vaults and exchanges are separate.
Yeah,
But
yeah.
in centralized exchanges, they're kind of the same often.
But actually, like in the original BitMEX model, like I think Binance has an insurance fund too, but like who knows when it actually attaches. Like in the BitMEX model, there is an explicit insurance fund that sits there and does take insolvent positions up to a certain point. I don't believe any perp dex has that. Like an
I think
explicit
Drift.
insurance.
I think Drift is the only
Oh,
one
okay,
that
maybe,
has
yeah,
insurance.
so-
Yeah, but like all the other ones. So my point is like there is this thing where you're apportioning the loss, right? You're splitting the loss somehow, and everyone's choosing a different split. And I think until this event, because ADLs are so infrequent, people were just like, like whatever. We chose a greedy algorithm. It probably works, right? I don't think there was a lot of like very thoughtful design in this choice of these ADL ranking functions. And now there's like insane amounts of people looking at this because like clearly those preference certain types of users quite a bit to others.
Well, I think it is important though to underscore that ADL is extremely rare, right? It's happened very few times in the history of these perp dexes. For centralized exchanges, it's only really these crazy tail events where that happens. Normally, the funding rate is supposed to solve the problem of bringing in, people on the other side and balancing out the longs and the shorts. So there are times when funding gets really lopsided, but ADL is genuinely an edge case, and it's important to not have people walk away with the impression that like, oh, ADL is like a very fundamental part of how perps work. It's a fundamental part of how they can work in the tail events, but normally this should never happen. Normally there should be enough latency to bring the other side into the market.
Right. I mean, I don't think ADLs are going to stick around as a major conversation point, for the same reason that very few people trading on the CME are talking about like the clearinghouse rules, in like.
I actually don't agree with that because during COVID, all the fucking clearing agents blew up and then these funds had to die because their clearing agent fucked up and didn't post collateral. Ronin Capital is the greatest example. If you want to Google the greatest legal case on this, Ronin Capital versus CME to 2020.
Totally. But that's like of hedge funds, of the 99.9% of the people that are trading perps with 50x leverage. Okay. They are not professional hedge funds. Okay. So I think that what's going to happen is 1% of the users are going to ask hard questions to all of the different venues that never really existed before. Just like when, smart contract hacks started happening for the first time, everyone really started asking about oracles and smart contract audits and all of these things that they never knew to really ask about before. Now, a small number of people are going to get very noisy about these edge cases, but 99.9% of society, I think, is going to like forget about ADL until maybe the next, mass liquidation event of this scale.
Yeah. So I think so ADL I think is reflective of a design choice. But the deeper design choice, if you look at lighter versus Hyperliquid, right? And I probably going to this conversation with caveat that I think most of us are investors into lighter and at least Dragonfly owns some hype. If you look at OLP versus HLP, so these are the vaults on lighter versus Hyperliquid. On lighter, the idea, and this is something that I think Vlad was on Twitter like actively arguing, like, no, this is good that we did this. OLP lost money, HLP made money. And this is
LLP.
because, I'm sorry, LLP, not OLP, LLP. LLP made money and, sorry, other way around. LLP lost money, HLP made money. And now from one perspective, you could look at this as a depositor and say, that's great. I want to be in the vault that makes money. I don't want to be in the vault that loses money. But this is zero sum against your users, right? So that means that more HLP traders lost that money and more more lighter traders made money because LLP was stepping in there to take some of those toxic liquidations as opposed to having those traders, be fundamentally in a worse position because all of that P&L is zero sum, right? It's coming from somewhere. And the somewhere is the traders. And so the question in some part is also, what is the purpose of these vaults? Why are they designed to be the way they are? Tom, I see you nodding. I'll kind of hand it off to you.
No, I mean, it kind of reminds me a little bit of the Jelly episode with Hyperliquid a couple months ago, where it was clear that HLP was being preferenced over, traders or exchange solvency or contract solvency. And I think for a lot of people, including myself, it left kind of like a sour taste, because I was also under the kind of impression this was supposed to be kind of this general public good, almost kind of like a investable insurance fund, like what BitMEX, as Doug was saying. And I think this sort of episode sort of showed that is true, that like this isn't supposed to be a true profit maximizing strategy that you can invest into. It's like it is supposed to be the kind of this like backstop for the exchange, and generally that works out pretty well. But in some scenarios, you might lose a little bit. And I think obviously people also love drama when also both of these vaults are up pretty massively over the past year. So it's like a 5% drawdown or 5% gain on a single day. Doesn't really impact the P&L of the vault strategy. But the point is that your P&L is coming from somewhere. And so, would you rather have it come from the traders or rather have it be directed into the vault? I also like this data point from Connor Grogan at Coinbase, who does a lot of on-chain forensics, that like, this is sort of like a little mini extinction event for, I think you looked at Hyperliquid, but I'm sure it's true for a lot of perps dexes or perp exchanges, that like almost half of the top wallets on Hyperliquid lost like 50% of their worth, and like 100 got totally wiped out to zero. And so it is like, there's a small number. Perp trading and trading in general is like so head concentrated that you do kind of want to protect those traders and like have them continue to trade. And so obviously when there's this sort of huge catastrophic event, like ideally you don't want them to be kind of wiped down to zero.
This is why I brought up that quote about the sheep, because it is really boils down to like your future round. This is a multi-round game, right? Like if you liquidate those users, that's future revenue you're not getting back. Either because they're like tasting their mouth is like, I don't want to go to this exchange that over aggressively liquidated me, or they're just out of money, right? And so I think there is kind of this very distinct trade-off in between the vaults and the traders, but in centralized exchanges between the centralized exchange and the traders, right? Because they kind of are the ones enforcing these rules.
Well, I think one major difference between HLP and LLP now is that HLP originally was both liquidity provider in normal times and liquidations when the order book couldn't absorb it. So originally, like HLP was very involved in the book, and now it's like down to 2% of the order book. And LLP and lighter is still provides a large fraction of liquidity. So I think like it's actually not, at least my understanding, is not as much a function of the liquidations are handled that differently. Both of them actually kind of do a similar thing when the order book can't absorb the liquidations. I think the difference was that lighter was in there as a market maker and actually supporting the books outside the liquidations and Hyperliquid and everywhere else, right? Like when normal market makers went offline, you didn't have anything in the book outside of that.
So LP was just getting run over like a market maker.
Yeah, I think
quoting
LP was
stupidly
just
at a
sitting
time when
there
it
and
shouldn't
absorbing,
have.
as it was going down, buy. And like
So-
you can see, like you can still see there are some like long tail coins, like the last one is like Kanye coin, where it's kind of stuck in it's tiny position, so it's not going to affect anything, but it's like stuck as like half the OI in Kanye coin, and it's like no, there's
So I one thing I will say is I kind of think the jelly incident that Tom mentioned, which we did cover on an episode because it's a very embarrassing fact for Sam Lesson, which I want to remind everyone of, that coin exists. But the jelly incident, I think, made sort of Hyperliquid get way more aggressive on their ADL policies after that. And I think they maybe overfit to the like small cap coin ADL, but then applied it kind of everywhere. And that was sort of very apparent in the difference between the two. And I just think like this is a kind of weird thing that, I know Robert's saying no one will
Hold on.
talk
I
about.
thought Jelly was not ADL. I thought they just like paused the market or something.
they actually
True?
changed the oracle. They force changed the oracle.
Yeah.
They changed the oracle.
Yeah. But the point is they couldn't really do ADL because it took too much OI. It was like it would have caused more issues if they actually executed, right? So if they did it when it was smaller size before the position got big, it would have been easy, right? So like that incident will make you refit your ADL model, like what quantile you start liquidating on.
I think in general it makes you think of like what's going to happen if I can't get out of a position.
Yeah,
Whether
exactly.
that's ADL or liquidations or force oracle or like anything, right? Like at one point you have to get out of a position.
And I think like these things, even though they seem minute, I think they actually will show up in trader retention. Like if I look at 6 month, 1 year retention of OI and traders, I think this stuff is sticky. Like people left BitMEX because of this. I feel like this was like half the reason people were like, oh, they're just like always purposely liquidating me. And like,
Well, so, okay, I want to go back to the question I posed, which is theoretically, on any given day, not just Friday, but every single day, half the people are winners, half the people are losers when you're trading perps. That's just how perps work. It's not like spot, right? With spot, like everybody can be winning and it's all great. So if this is true, why does it not feel true? Like it feels like a little bit of a paradox that like everybody seemed to be having a terrible day on Friday, much more so than usual.
I mean,
even
for
though
the same
theoretically it
reason,
should not be true.
for the same reason that when you walk into a casino, right, you hear a lot of complaints from the people who lost $100, and you don't hear that much cheering from the people that made $100.
Right, but is that not true every single day?
Yes.
But like it's not true every single day. That, like people are
I think to a certain
complaining
extent,
that
it's right. Some people win, some people lose, but people have different sensitivity to, for whatever reason. So I do know at least a couple of larger firms are not doing great, took some losses. Market making firms took some losses from this because they are dependent on like, we're going to hedge here, we're going to hedge there, and whether the APIs are down or they get ADL'd. And like for them, if I'm a guy who punts, right, and I'm up 30%, I'm a gambler. That's, just another day. But if I'm a market making firm, I'm wiped out. That's, not great.
Okay, so maybe the way to describe it is that the P&L is equivalent. On any given day, the P&L is equivalent. P&Ls cancel out. But the allocation of risk got all janky, right? Is that normally markets supposed to allocate risk correctly and say, okay, you're long here, you're short here, you're hedged because you want to remove your risk. And when ADL start happening and everything starts going topsy-turvy, that's when the allocation of risk just breaks. And people who weren't supposed to be taking risk are suddenly taking risk.
It's the opposite. Yeah, it's the people who are most risk averse were forced into taking the risk.
Right.
Yeah, exactly.
Right.
But I think like a lot of times, like, oh, sorry, go ahead.
No, go for it.
I was just saying, a lot of times, like financial crises, like it's not necessarily the amount of loss; it's when stuff that's perceived outside anywhere. It's when stuff is perceived as safe, and all of a sudden it's not safe. Like those are the worst financial crises. When a lot of like levered hedge funds lose a lot of money, it's like, well, the system can absorb that versus like a money market fund breaks a buck.
I think another thing is this, the exchanges made money. That's like to
Robert's
extending Robert's analogy. You're saying it's zero sum, but there is a sense in which the exchanges took a wider vig than they normally do, and that feels bad for people, right? The exchanges took like even higher percentage than normal.
But to add one more layer to this, the people that made money were short. They were short going into this insane scenario, right? And I think to your point, Haseeb, why don't we perceive it that it's zero sum and everything nets out is because a lot of people lost a lot of money being long crypto. Long is good. Long is what everyone is supposed to be in crypto. And when they got wrecked, they all went to the timeline and acknowledged the fact that they got wrecked.
But it was like a V shape, right? So there's as many people making money on the long back up.
Well, it's a V shape for some people.
No, but everyone who got liquidated.
Some people got.
If you're in Kanye's point, I'm sure you didn't.
No.
I'm sure.
But this gets back to my point about the multi-round game. Like, if you liquidate all your users, they don't have capital to come back for a lot of them, right? Like, they're not going to come back.
The other interest. ADL made some people who were up actually complain. Like Andrew Tate was like, I can't believe this. What the hell is auto deleveraging? And somebody saying, well, if you didn't get auto deleveraged, you'd actually have lost money because it took you out at a good price.
Yeah, that makes sense. Is that people even who were up because they were ADL, they were mad.
Yeah.
And so I think it's just like the unexpectedness. It's the unexpectedness that people really do not like and causes everybody to complain and get angry because again, it's like this allocation of risk thing is that people who are not supposed to be down are down and people who are not supposed to be up are up. And the people who are up aren't out there being like, yeah, I made money. This is great because they were not out there to like try to make a bunch of money.
There was way more complaining in the casino than celebrating.
Honestly, I look, I don't really like have many thoughts about Mr. Tate, but I will say the video he made. So you wrote a tweet that says leverage trading is satanic, and he made this video. It is kind of hilarious. It's a video about this having a profitable position getting ADL'd. So I'll tell you, people, if you want to see the emotion that comes out of this, watch that video.
Boy, I do not. Okay, wow.
A quick search. I have found the video after this show. I will watch it.
Okay, all right, great. So, I mean, another thing, of course, as with any aftermath like this, we saw a huge wipeout in the total leverage in the system, and the open interest on almost every single platform massively dropped. Alts were hit a lot worse than Bitcoin, but you saw basically alts open interest pretty much halved. And a lot of people were blaming the massive drawdown that you saw in alts. Many alts wicked down like 80% plus. Even assets that were worth, nominally 10 billion plus had huge, huge drawdowns. And people were claiming that a lot of this is because of cross margining. Is that basically this is the first massive drawdown where you actually had these really robust cross margining systems where like your sweep position or your IP position was getting liquidated as collateral for your whatever else you had in your portfolio. And so this caused this kind of reflexivity on the way down for a lot of alts. But that open interest hasn't built back up yet. It seems like it's now starting to build back for Hyperliquid. I think Hyperliquid dropped the most in open interest. Like I think it like more than halved after the drawdown. But it seems like it's
it was
recovering
like
quite a bit.
15 bill to 6 bill, something like that. 15 or 16.
Yeah.
Massive, it was quite large. Yeah.
Massive haircut. And I'm sure some of this was because of, like the basis trade across different perps exchanges. But it seems like some of that interest is now coming back. Obviously, it's Monday. Trump is tacoed, as they say, and so all is well
I
again.
just think the most hilarious thing is my group chats where there's like crypto people and equities people, and the equities people were like, "Haha, markets closed. Fuck you guys." And then the crypto people are like having this like meltdown. It's like kind of
the
funny.
bond market people aren't even back to work yet. It's
yeah, exactly. They had today off.
Yeah, it does kind of feel like somebody threw like a smoke bomb and then closed the door.
Well, I mean, it also probably like didn't help that this happened right after market close, right? Because if you have the ETFs trading, like at least you have some liquidity on like the actual markets to buy the dip when it goes down, but like you didn't even have that online.
I will say I did enjoy plotting the Trump token complex against a basket of other alts, and it was down a lot more than the rest. Like during that spike, it like really Trump and Melania like really sold off. Not as much as Adam, but they were like 70-80% down.
All right. Well, speaking of Trump, one of the other stories was talking about the buildup to this whole drawdown, which was what's now being called the hyperliquid whale. So what happened is, of course, this whole thing was catalyzed by Trump tweeting that, oh, hey, we're going to restart the tariffs against China. And apparently about something like 30 minutes before this announcement took place, there was a whale who had hundreds of millions of dollars worth of Bitcoin that they deposited on Hyperliquid. And they deposited this just a very short period of time before the announcement was made and closed that position like I think within minutes of the announcement and like the big drawdown that took place, making people believe that this was somebody who had advanced knowledge that Trump was going to do this. And their P&L was like something like $200 million that they made on Hyperliquid, entering into this massive short position that may have been the initial push for markets to start teetering over, just kind of absorbing the shock of this massive short that started on Hyperliquid. So if you remember, there was another episode like this also on Hyperliquid. What was it? What was the precipitating event? It was also a Trump.
I think it was also the Bitcoin whale. This guy with like really old Bitcoin address who just deposited through unit like like $1 billion in Bitcoin or something like that.
That wasn't tied to a specific event.
No. It was just
huge.
You just see this. Yeah.
Wait,
movement.
is this the same whale?
No.
This is a different guy, right? This is
different.
This is yes. This is a Bitcoin whale, but there was
first time it was Tarun. This time it was Tarun wearing a hat.
I wish.
Okay.
That would have been funny.
I think it was notable because that was like a super old address that just woke up after like 10 years and started to go punt some perps on Hyperliquid.
Right. But whoever this person is who did a massive short on Hyperliquid, almost certainly they were somebody who had advanced knowledge that Trump was going to tweet this, which makes it seem that like, okay, well, that's not a long list of people. It must have been somebody who's connected to the US government, or maybe somebody in China who got advance notice that like, hey,
I think it's circumstantial or coincidental. Like,
you think it's circumstantial coincidental?
Yeah.
Wasn't the Chinese announcement the night before that the rare earth thing, whatever, that he got mad about?
I think people were saying that like this was like an open conversation topic in China, that like this was already happening, and so it's not like maybe
but U.S. markets shrugged it off, right? Because this news came out the day before, and U.S. markets were like, whatever, China's doing
crypto
stuff.
is a global market, Haseeb. It incorporates global information. The U.S. markets might not for this particular thing.
So you guys don't believe the conspiracy theory that this person had some kind of insider knowledge?
Isn't he losing money on this current short that he's doing, like quite a bit?
Maybe it's to cover up his insider.
Yeah,
I know,
that's the theory.
Sorry,
I think that actually is very plausible to me. I actually find this extremely plausible.
Well, at the very least, it answers
the
your
amount of
question.
attention on this address is like insane. You know, it's like the number one story I saw on social media was like focusing on this address. And so
Every
if you are at this
conspiracy
address-
theory is based in something plausible, right? It's not like it's like, you know, that unreasonable of an
Look,
idea.
here's what I'll say. Here's what I'll say is like the lesson that I've learned from being in crypto for like the last 5 years is that it's almost always exactly what you think it is. It's just like you just keep like 2022 taught me that is that like it's always
Haseeb's
exactly
razor.
what it looks like. I mean, it's just like that's like the crypto razor.
Yeah, we did get the other Occam's razor, Haseeb's razor with James Wynn this week too, where there are all these conspiracies that like, oh, James Wynn is CZ, or like actually it's Jeff and he's trading to like, you know, make the exchange more notable. And then he went on like a Spaces and just some like random British dude who honestly sounds kind of stupid. He just complaining. I think he was complaining about getting ADL this time around. Yeah, he sounded pretty drunk. So I was
drunk. Yeah.
There you go. That's the simplest answer.
Okay. So you guys, so you guys are totally zero credence to the story.
Actually, I will say one thing that was funny about this
Okay.
address. How many conspiracy theories were they trying to dox this guy? No one was trying to dox this $1 billion depositor, or at least I didn't see any like active effort. Whereas whoever this is, like it's like an internet true crime documentary.
If it's true,
or
it's a
something.
scandal. Yeah, because this is like insane. You know, this
Right.
is,
It'd be like
extremely-
Watergate, you know?
Yeah. This would be like extremely, national news if it was discovered that somebody was insider trading
Whether it's
on Bitcoin,
US
on Hyperliquid.
or ex-US. Like if there was some spy that got this info, that's just as salacious.
Oh, it's like intelligence.
True.
Yeah.
Yeah.
Imagine it's
Russian
Watergate,
intelligence.
except the CIA breaks into an apartment and it's like a mattress on the floor with no bed and no other furniture.
Yeah, it's James Wynn, drunk out of England, trading just crazy.
Hold on, Doug was about to put in a word where he was
I was just
commenting
gonna
on
say.
my
I was just gonna
conspiracy
say.
theory.
At least it answers the question of who was up and who's celebrating. Celebrating the casino is Barron Trump. I guess will be.
Okay, yeah, that's why we're not hearing about this about the winners, because the winners is all Barron Trump. That's the answer.
Yeah.
He has all the P&L on the other side. Yeah. Okay. Well, I think we can now say that we're mostly at the end of it. The dust is settling. Obviously, there was a lot of snafus and a lot of learnings on the infrastructure side. I'm curious for you, Doug, for Tarun, what are you guys seeing from infra providers? Right. So there was a lot of failures and a lot of stuff that just totally fell over amidst the market mayhem. Any learnings, reflections about like how things are going to be hardened going forward?
Yeah, I mean, it's always tough, right? Like it's just crypto, the level of traffic, like and you're on a DEX or on an exchange, right? It's just the level of traffic spikes that you get on this stuff. It's just power law. So it's always tough to like predict this, like how much traffic you're going to get until it actually hits. But at least you have some data points there. I don't know. It's crypto infra is always should be fixed, and it's always like, oh, the exchanges are always falling over, and they've been falling over for 10 years, and my guess is that most exchanges will keep falling over when shit.
Well, so somebody was asking me this today of like, why can't you just load test this stuff? And I was like, well, it's not that easy. Load tests don't always reflect reality. Da da da. But I was like, I don't actually know why you can't load. Why does it keep falling over?
People do their best to do that. I think it's just like always some unforeseen fucking thing. Like, oh, like like Ethereum gas went up too much in my fucking L2 transaction that's not getting in. And like there's so many of these
that does
weird.
seem like that's one of the things that you should be load testing.
I don't know. It's not that they don't. It's not. I don't. It's not that people don't.
I'm starting to think that they actually don't. Like that
I
a lot of
don't. I
people
don't think that's
load
true.
test
People
these things.
definitely do a lot of this type of stuff.
I mean, I
just
guess
think-
one thing, you don't necessarily get punished in the market, right? Binance went down for 2 hours. Are they going to lose? Are they going to get punished?
They
in the
lost
market for it?
283 million.
Yeah, that's true.
I-
Yeah, that is true. Yeah, but
I actually would give some credence to the Solana L1 kind of version of the world, which Doug is sort of also favorable, which is like it forces you to test this more aggressively than say the sequencer model. I think like I do agree that people running L2s tend to have a little bit like weaker testing because they kind of like assume that like they have some invariant about the sequencer, like it's all in this one data center or whatever.
Yeah, I
And
mean, and
people in L1 can't assume that.
Yeah, and like you did have stuff like, okay, there's an L2, and we have like forced inclusion if the sequencer goes down, and like, right, we did have a case of the sequencer going down, and I don't know if anybody knew how to do a forced inclusion transaction. So it's like a lot of this stuff is like theoretical until it's not theoretical, and then people are like, oh shit, where is this in the docs? This isn't well documented. This isn't so.
The docs are going down. That's how you know. I mean, it's like
Gitbook
yeah,
is a
that's-
public good. We need to like have it nationalized.
Well, that's the
Right.
thing, like the blockchains worked, right? The blockchains worked. Everything else on top of it, TBD, right? It's kind of like, okay, yeah, you know, every blockchain was technically doing what it was supposed to, and the gas limits were going up. I mean, does that count as a failure when Ethereum is $400 a transaction? I mean, Mert was on Twitter being like, oh, well, obviously this means that Ethereum is broken. And I think that argument is very compelling to people. Is that like, yeah, if it costs $400 per transaction, it's broken. That's not how it's supposed to work. I think for a hardcore purist, it's like, well, no, that's the market clearing price for an Ethereum block space, and like that's how it works. But I think for users, they're like, no, absolutely, no, don't agree.
Actually, Haseeb, can I reformulate your question slightly?
Yeah.
Which is, I'm going to ask Doug, what things are you changing in the perps decks you are designing based on this? Because I feel like that is a more like, you know, like what are things that you will change?
Yeah. So I mean, I think one is right, like we run like on chain. So like to Haseeb's point, right, the chains didn't really go down. So like a lot of perps dexes aren't necessarily on chain. There's on either on a sequencer or you know, something that's more opaque. So like we're trying to put pretty much everything on chain itself for like all the clearing. Two, I think like the insurance stuff, I think you kind of definitely need an insurance fund in these systems. And like that goes to your point, Tarun, is like it's not great optically when the vault makes 40 million and there's nothing like no insurance fund loss. Yeah, I mean, I'd say those two things are like pretty critical. You know, you don't want downtime and you don't want kind of like unfair gains from your ADL and liquidation systems.
Okay. Well, we are up on time. Doug, we really appreciate you coming on and educating us about all the microstructure stuff. Very helpful to have you in a moment of crisis. Anything you want to plug or direct people to?
Yeah. So we're building a perps dex, and hopefully next time this happens, will be a good place to be trading at. It's Ambient Finance. That's on Twitter at ambient_finance, and also we're co-building with Fogo, which is a new L1 kind of designed to handle this throughput, and that's at Fogo Chain, Twitter.
Fantastic. Well, we appreciate all the enlightenment that you have brought our way, and we hope anybody who is ADL'd, anybody who made money, anybody who lost money. By the way, if you made money, you should tag us in this tweet because I want to know. I want to hear from the half of you. Yes. Don't DM me.
If you
Tag
lost
us in the
money, DM
responses.
Haseeb.
If you're, if you weren't looking for refunds,
If you lost
DM
money,
Haseeb.
yeah, exactly. Haseeb is processing Binance refunds for the
That's
next
right.
2 weeks.
Yeah, any exchange, anywhere you need refunds, just hit me up. I am the port of first call. Thank you, everybody. Hope you're all safe, and we'll see you all next week.